let's go into the business. All right. So if you go over here and you look at my 15-minute chart, and the 15-minute time frame, what you're doing is you're looking at time first. So here's 7 o'clock in the morning today. All right. At 7 o'clock in the morning, that begins your hunt for relative equal highs or relative equal lows. Because if you're looking at prior to anything at 7 o'clock in the morning, what you're really doing is you're referring to London Sessions price data and its profile. This reference point at 7 o'clock, if you know how to trade other price action models or ideas that I taught, and you've been with me as a student for a while, and you do trade London setups as a continuation or a potential reversal for a New York session market reversal profile, where what that means is London session between 2 o'clock and 5 o'clock in the morning Eastern time. It's New York local time always. If that session time has seen the market drop like we see here, okay, if there's going to be a New York session market reversal profile, that means that they're most likely going to see price trade back above and overlap all of the movement that was started at 2 o'clock in the morning here. You can look for setups prior to 7 o'clock in the morning, but if you're brand new, don't even worry about that right now. Trust me, you don't need anything else prior to 7 o'clock in the morning at all. At 7 o'clock in the morning, what you're doing is that's your beginning of the day. You're now starting to look for relative equal highs and lows. And you start on what time frame first? The 15-minute time frame. Okay. So this starts the hunt for at 7 o'clock. Did we create a relative equal high yet? No, we just have one singular high. Do we have relative equal lows? Don't look at this because it's before 7 o'clock in the morning. Don't do that. Don't even refer to it. The rules are very simple. You're waiting to see relative equal highs and relative equal lows form after, post 7 a.m. New York local time. Now, these two lows may be a factor for the 5-minute chart. So we're going to go to the 5-minute chart and expand that. All right, so now we do potentially have, if this starts to rally, we don't have it yet, this could potentially become relative equal lows. Now with that, all you're doing is you're making a mental note of it. You're not annotating your chart because it's not there. You never, never, never lead your expectations with something that has not actually formed in the chart. Don't predict the setup. You have to wait for the setup. You have to wait for these signatures to form in price. So post 7 o'clock, you're scanning through, looking for relative equal highs and relative equal lows. We can't refer to that low because it's before 7 o'clock in the morning. So we go down to a 1-minute chart. And here is the 7 o'clock delineation. And you're looking for relative equal highs. Now, these have already happened, okay? So that's something that you could have observed at the time at 7 o'clock in the morning. We weren't here, obviously, at 7 o'clock, but it ran through there. So what did this do? Okay, think about what I was talking about yesterday. There's two different characteristics in price delivery that is a very, very simple perception of what price has done. It took an area that's smooth and made it jagged. So what happened here? This was an engagement for liquidity. So what did it do? It took buy side. After it took that buy side, where did it go directionally? Lower. So if it's done this type of work, then you have to go back through this price leg from here down to there. See that? So what you're going to wait for is something after 7 o'clock in the morning to create relative equal lows. It could rally up, and then these relative equal lows could be the setup for a run lower. And if it goes below these relative equal lows, and I'm not saying it's there yet because I'm not trying to push that on you today, but these are the things you're doing as you're watching the chart. You're observing and referring. So if these become relative equal lows and it rallies higher than this high here, these become relative equal lows. And if it wants to go below that, how far can it go? Refer over there. That's not the same thing as looking at relative equal lows before 7 o'clock. You're just looking for liquidity for the sake of just simple liquidity. And you're referring to how far can it go beyond relative equal highs or relative equal lows. You got to look at market structure outside this parameter. But initially, all you're looking for is to get a draw or a short-term bias on a time frame, whether it be 15, 5, or in this case 1 minute chart, where it affords you movement. You're watching to see how it attacks or tracks to a relative equal low or a relative equal high. We already see that they've done some work up here. There was a shark frenzy, okay? There's blood in the water up here. We don't want to trade up into that. We don't want to trade into this because they've already done a lot of things in here. So what we're doing is we want to see it try to make an attempt to run out some kind of a relative equal low. That's what you start with. It doesn't mean you're right. It doesn't mean it's going to pan out. It's just that's what you start with. That's the process. So you work from the 15-minute time frame, look for relative equal highs, relative equal lows after 7 o'clock in the morning. Even if you see them obviously right before 7 o'clock or during the London session, ignore them. All you're trying to do is learn how to encapsulate price action. If this price, say all this price action here was over the course of, I don't know, 15-minute time frames or 30-minute time frames, and this was the close at 4 o'clock in the afternoon New York time. What that would indicate is that this was the daily range. It created the Judas swing here, it dropped down, and it came off the low to close near the low of the day. That's power 3. You're going to discover that every single time you sit down and you look at the AM session, you're essentially looking for that to form. You're looking for some fake manipulation that creates all this animation, and it does the harmful work of hurting people and putting them out of a trade that would have been profitable or putting them in a direction that's not right. And now they're trapped long in this case, and then they rake them across the coals and drop it lower. So you're looking for where the retail or street money trader is going to be, or less informed trader, they're going to be looking for support and resistance. I'm not a support and resistance trader. I don't teach my students to trade support and resistance. We look for liquidity and inefficiencies. And when you go through the process of looking for all of the relative equal highs and relative equal lows on the 15-minute, the 5-minute, and 1-minute chart, once you have either panned through and either identified what's available on any one of those time frames, or if there is none that's obvious, then what you do is you go through your charts and you annotate all of the inefficiencies. And we're going to work our way back up. So right now we're on the 1-minute chart. So this would be like this. You see this. There is no volume imbalance in here. So you're going to start right at the candle's low, drop it down to the very next candle after the big long down close candle. What kind of candlestick fair value gap is this? Sell side imbalance, buy side inefficiency. That means it offered delivery on the downside. It's inefficient in any movement back up inside that same range that creates this one single pass through until you get into this area here. So that's the furthest we went back up into this range right there. So it's inefficient by characteristic and definition, anything above this high up to this candlestick's low, right there, that candlestick's low. All of that is inefficient and is inviting the opportunity for price to want to trade up into it. Doesn't mean it's going to happen right now. Doesn't mean it's going to happen this session, but that's the characteristic. Then you have this one in here. We've already worked this one there. So there's a small little section between that candle's low and that candle's high. From this candle's high and that candle's low, essentially this is what's remaining in that. And then over here, this inefficiency, let me fix this because I always want to refer to the original fair value gap, but noting what level of inefficiency is still available. That means a small little section between this candle's high and that candle's low right there. So I always keep the original fair value gaps, the levels, because they're key. They can be used again. They're influential. It's not so much that I'm only looking for the remaining unfilled portion. I am aware of seeing that because I can see the difference between the high of the fair value gap and this high of that candle. So I'm not trying to make any special distinguishing note of it. But in my mind, subconsciously, I know that if I'm going to go back to that, it may go back here just to tap the high of it, and then it'll be it. Or if it goes above it and comes back down, then I could use this candle's wick and halfway point of it. That's how far I can retrace back down into it, and it becomes an inversion fair value gap. When I have a candlestick like this, okay, when you're annotating your inefficiencies, we have this one here. There's no volume imbalance up in this segment to here. Is that accurate? Look closely. Mm-mm. The low of it needs to incorporate that volume imbalance right there. The volume imbalance is the separation between one candlestick's body and the very next subsequent candlestick. If the bodies don't overlap or at least touch, there's a volume imbalance there. Yes, the algorithm repriced up into there a little bit. That's fine. Where's the body? Right there. The volume imbalance tells you to ignore any of the wick. This wick will not be all that influential. Whereas if you were without a volume imbalance in here, let me zoom in. So that's the volume imbalance right there. Okay. So if you have a fair value gap or an imbalance and it has a volume imbalance in it, any wick inside the fair value gap just completely nullify any intention on that. So the volume imbalance right there, that tells you if you have that and any wick in there, just completely disregard it. Only if it's a wick that's below the consequent encroachment, which is the halfway point here. So any wick that reaches up to that level or less, ignore any of those wicks. You have to take it to the body of the candle. Okay, so that gives you the true, real fair value gap, or in this case, a SIBI, sell side imbalance, buy side inefficiency. All right, so that's the business there, and extend it out in time. And the market goes right up to that high and then folds and creates what right here? What is this? That's that fair value gap between this low and this candle's high. And you see it trade right up into consequent encroachment plus a little bit more. Why? Why? Because the algorithm is affording anyone that uses this information, that uses this level as an entry point, they have to offer them the spread, right? Or they won't get their fill. And that's why you get this little bump right above right there. But you're going to be told that that's buying pressure. But you want to go through the charts and you want to highlight these things. And since we have done this work up here, where we had relative equal highs here and here, how do you know it's a high probability relative equal high? When the right side that is identified as a potential turning point for a quote unquote potential relative equal high, the right one is going to be slightly lower than the one on the left. We have that here. We don't even need to see this ahead of time. We just need to see, okay, it ran that, and you might identify it after it does that run there, and then you start seeing it break down. See that? At the turning points or potential turning points like this, okay, this is a note that's real important for you, okay? Inversion fair value gaps, the highest form of precision, the ones that are really, really trustworthy, the ones that have the highest degree of working in your favor, depends on what I'm building on here. Whereas we have an area that's smooth after 7 o'clock, so the 7 o'clock in the morning starts the AM session. So now you start hunting on the 15-minute time frame, the 5-minute time frame, and the 1-minute time frame. You're hunting relative equal highs and lows to form after 7 o'clock. Well, we have that here. You may not have had the experience to anticipate this run up. That's fine. You don't need it. You don't need it. Remember when I first taught breakers? The idea of waiting for a stop run and then wait for the market to come back down in to the range prior to all that run up, and then wait for the bearish breaker. In this case, the bearish breaker is this candle and this candle. The most sensitivity is going to come inside of the most lowest down close candle prior to the run up, because you have a high, a low, and then you have the stop hunt, and then the reversal. Well, that's trading with a breaker. Inversion fair value gaps, if you have a gap inside of the range that creates the bearish breaker, as we have here. Now, this is going to be a huge step in understanding narrative and understanding directional bias and also reversal patterns. But this buy side imbalance, sell side inefficiency, that fair value gap, is going to have a roll reversal. That is an inversion fair value gap. So the market creates this fair value gap after this run here. You don't want to use that as a buy. We're so elongated and stretched out from London, and it's past 7 o'clock in the morning. So now we're in an AM session. AM session characteristic is always, first and foremost, characteristic is retrade back into the London range. The London range is whatever the highest high and the lowest low was between 2 o'clock in the morning and 5 o'clock in the morning, Eastern Standard Time. So if we're anticipating a rally up because of these relative equal highs, and it's after 7 o'clock in the morning, and it creates this type of reversal scenario where it breaks down, your eye should go right to, are we looking for relative equal highs or relative equal lows, or are we looking for inefficiencies? You have to go with what the chart's giving you. You can only trade with the premise of relative equal lows or relative equal highs if it's in price action. If it's not there, you can't refer to it. So if there's nothing else in price because we want below these relative equal lows there, what's left now? At this price point right here, if there were not anything else on the chart yet over here, this is the only chart candlestick at the time you're watching it. Where does your eye go? Well, you'll naturally go to this, but my eye jumps to the stop hunt here and the breaker. And from the breaker to the high where the stops were taken, is there a fair value gap? If there is, I'm going to navigate away from the breaker, and I want to have that premium level right there. I want that. That's the one I want. Everybody else might be trading down here, and they might get a fill right there, and they won't be comfortable trading into this high here or right there. See where it's stopping? It's not random. The market breaks down. That Q, working off of that inversion fair value gap, that drop, and it creates this gap right there. That right there is the sweet spot when you're bearish and you have everything behind you that's in play. It's your optimal trade entry. It's your model 2022. It's right there. And then this becomes a selling point. And now what do you have at this point? You have this low and this low. And what time of the day is that? 8 o'clock. So the price is rallying up against the underlying expected move or directional bias, because this move here has caused a potential reversal. So now you have relative equal lows here. But how far can it go? You have to refer to the range prior to that reversal pattern that formed after relative equal highs have been taken. So let me slow you down because you're getting a little panicked, I'm sure. This is too much information, my head's spinning, ICT. All you're doing is you're looking for areas where they can stop people out and go the other direction. That's essentially all you're doing. And you're looking for little periods of price action where obvious highs can be targeted, obvious lows can be targeted for liquidity purposes. And in between them, or if there's nothing new to work off of, then you focus on all of the fair value gaps, the inefficiencies. That means things that we've been coloring here with the rectangles. Okay? Your eye will jump to them with experience. You'll see them more the more you do this. And because of that experience factor, you'll learn to filter out some of them because they've already been used several times. It doesn't mean that they won't be used again. It just means that the ones that are unfilled or left in a state of imbalance, like this portion of this gray box here, from this candlestick's high to that candlestick's low, there's a little bit of inefficiency. And graphically, it looks like this. That's the remaining portion that's inefficient, that little segment up there. It doesn't mean it can or needs to fill it right now. It's just that's the part that my eye goes to. But you still want to have the low, the midpoint, which is consequent encroachment, and the high. You want to have those levels all the time because they will refer to them. If the price is trading anywhere around this range here the rest of the day, watch and see how it uses it. It will use it again. So if you want to talk about support and resistance, these inefficiencies are the real support and resistance in price action. You'll see them, kiss them, turn on a dime, go right to the level, stop, turn around, the bodies of them stop. Like it's so precise. It goes without question. It's laughable for anyone to say there isn't an algorithm. These price engines, what are they referring to? Think about it. What are they referring to? They have, if it's an algorithm, it has to refer to something that's happened in the past. So what I've done is I've created a language where you're either going to be reaching for old highs for the express purposes of taking out or engaging that liquidity that would be resting above it in the form of buy stops, or going below a low or equal lows for the express purposes of going down to engage the sell side liquidity or sell stops. Outside of that, what are we left with? Anything that's inefficient in terms of price action. So if we have an inversion fair value gap here after these relative equal highs have been traded through and it starts to break down, no panic. Don't worry about panicking. There's no reason to do that. Go into this price run here. That's your breaker where it runs up and tags all the stops, gets people stopped out. If they were short, they're not allowed to be profitable. Or trick them into a long trade, and then when they start raking them across the coals going lower, they're unprofitable. If that's the case, your eye goes into this price run. Is there a fair value gap there? If there is, extend it forward and then wait for it to trade up there. Don't sell yourself short and only look for the return to the breaker or the low point, because it's going to trade right back up into that. And notice that this is the only buy side and bounce, sell side inefficiency. And once you have a valid return here and it sells off, what you should be focusing on is all of the SIBIs. All of the SIBIs until the narrative is likely to change bullish. Your focus goes to only looking for sell side imbalances. That means a down close candle that has a segment with the previous candle's low, and the subsequent candle after it has a high that doesn't connect. And the only bridge between those 2 points is the down close candle in between. That's your fair value gap. And it's specifically a sell side imbalance, buy side inefficiency. And by having that, what that does, it removes the ambiguity. And it gives you a very specific process of saying, okay, I'm only focusing on these specific fair value gaps. I get that question a lot, even with private mentorship students. How did I pick that one? Why did I pick that one? Why didn't I pick this one over here? Well, that comes with experience, and I don't make any bones about it. I don't sugarcoat it, and you're going to pick it up because you've been doing it long enough. But when you start looking for it, there's specific fair value gaps, Caleb, that I want you to focus on. Okay, the very first fair value gap prior to a stop run, always have that one noted, and that's why it's colored red here, because this is a change in a direction, and what this is doing is acting just like an order block. It's just change in the state of delivery. Oh, so I'm incorporating narrative where the market goes up after 7 o'clock, stop hunt, change, breaks lower, comes right back up into inefficiency, but to a very specific fair value gap. It's the first one prior to a stop hunt. Okay, this fair value gap, okay, if it's not there, then you use the breaker. It's very simple. It's the last down close candle. Okay, but your stop needs to be above the highest high of the consecutive down close candles, because this is all the bearish breaker, both of these candles here. So your stop has to be above that. Okay, how much? Oh, two ticks, maybe 1 tick. Many times I've used this the high, because if it's really good, it really won't like to go back up into the full range of that. So using the very high of that, in my case, it would be fine. Not if you have this gap here inside the leg that has the stop hunt, because if you have that, then you could potentially see a whole return back up into this, and maybe a little mohawk, a little tiny little spike above outside with the wick of the candle, but the body be inside or below that gap. So that's all part of stop management. So I talked that in there with no extra charge. But that changes the state of delivery, meaning that we went up to stop out, and then this is where everything algorithmically changes. Now we're going to start going lower. It's going to seek sell side liquidity. It's going to reach for sell side. It's going to expand lower. So you want to key off of and look for turning points, or what will be future entry points for you, Caleb, for trades that key off of these sell side imbalances, buy side inefficiencies. Every single SIBI, every single short-term high. So why do you want a short-term high noted? Even if it's a singular one, because there's stops above that. Okay, we already have a relative equal high here that formed, and it caused a potential reversal that moves lower, that seeks liquidity. We had relative equal lows here. It traded down through that, and then we had all this business in here. So every sell side imbalance, don't see anyone in here. Yeah. Notice how this one here, what is this one? What's this fair value gap? By classification and name, what would you call that one? It's a buy side imbalance, sell side inefficiency. Okay. I'm not looking at that one. I won't highlight that one. I won't extend it forward, because it's against the underlying direction and the state of delivery, which is it wants to go lower. So if it wants to go lower, I'm not interested in this unless it shows me that it wants to reverse and it's done something very violent down here. Like it could do it here. I'm not saying it will, but if it did something violent and started to reverse, then I would draw my attention to this one because then I could act on that as an inversion fair value gap because it would reverse its role. But right now, when the narrative is in motion, every sell side imbalance, buy side inefficiency, I'm referring to. I'm not always drawing them out on the chart because, as you'll see, it can be rather busy on your charts, and I like to keep things naked but not afraid. And you can see it trading up into the consequent encouragement of that one. So at 8 o'clock is the same thing. I talked about the first 30 minutes after 7 o'clock and after 8 o'clock and after 9 o'clock. That is your pre-session range. Okay. It is 30 minutes of you expecting something opposite. So in other words, if you see relative equal highs, what would you expect after 8 o'clock? You would expect a low or a price run lower. What is that by definition? Opposing directional run that's against where you think it's directionally going to go. That's a Judas swing. That's manipulation. It's something that then it's more efficient for the climb to go back up. Well, in this case, we have a descent. Even though they were not trying to trade relative equal highs and lows prior to 7 o'clock in the morning, if this does this and it starts to move lower, you have to incorporate the range. What range is that? The low that was formed prior to it crossing the threshold of 7 o'clock in the morning. So we have all of this run here. So every single one of these inefficiencies over here, 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 even though it's been used already, you extend them in time. And they will be places for you to anticipate price going up to and pushing into it and then resisting and going lower as it works and gravitates to that low right there, as I was hinting at earlier. But the range, okay, the pre-session or pre-market range after the top of the hour, whether it be 7 o'clock, 8 o'clock, or 9 o'clock. These are your three windows of opportunity. So right away, we can study and see, okay, there was really nothing in here except for these two right here, these little small little ones. So what did it do? It rallied up. Where'd it go to? Some random level. Nobody could have known that it was going to go to that level. But now you do. You have a stop hunt. The market broke down. So this is a shift in market structure. Okay. And this is a optimal trade entry. But now you're learning the signatures that present a greater degree of precision and managing your expectations in the narrative. How are you going to incorporate all these things and trust holding on to a trade? So now we're going to go into each hour at 7 o'clock, in this case 8 o'clock, and at 9 o'clock. What you're doing is you're starting the whole process all over again. You're waiting for relative equal highs to form or identifying relative equal lows. At 8 o'clock, you can look prior to 8 o'clock. You just can't look prior to 7 o'clock for relative equal highs or lows because you're trying to work inside the range of the morning session. Okay, the morning session is essentially 7 o'clock to 11 o'clock in the morning. Technically until noon, but 11 o'clock for me. Once you have a turn in the direction like this, and the market's likely to draw lower, you'll see that by focusing on only one side of the marketplace with the inefficiencies, as we have here, it's moving lower. So every SIBI is extended to the right. And many of you, when you see me talk about inefficiencies, fair value gaps, SIBIs, BISTs, all that business, you anticipate that, oh, it's a matter of just going up. Once it gets into here, all you got to do is sell short right there. That's not it, folks. you have to anticipate a measure of manipulation. What was the price doing here? I told you it was getting kind of sloppy. We had this inefficiency, yeah, but what else is there? What else is there? You have this energetic drop that created that SIBI, and there's going to be what trailed there. For anyone that's short, they're going to put their stop loss right there. Well, that efficiently been removed with this bump here. Back into an old SIBI, and then you have a market breakdown. Look at the work around the halfway point, which is consequent encroachment. The market drops, opens again here, breaks lower. We have an inefficiency. The bodies are telling you, yes, this is going to go lower. Why? Because it stops right there. See that? The wicks are allowed to do what? A little bit of damage. Is it going to random locations? No, it just bumps the bottom of that civvy over there, right there, and then works lower. Now, at 9 o'clock, the same thing. You can look at any relative equal high or low prior to 8 o'clock up to 7 o'clock. If you're going to be trading with longer term price runs, for the folks that are asking me, how do you hold on for longer trades? In that case, you're going to have to look at the previous day's range and what is the previous day's low, or if it's going higher, what's the previous day's high, and that's your next logical level to reach for. But in short, what you're doing is at 7 o'clock, that starts the hunt for relative equal highs or lows. If you see a disruption like we were talking about yesterday, where it's jagged, you see how it's nice and jagged? That's indicating it's probably going to go the opposite direction, especially if you have all these other supporting factors where that would have been a breaker. This is obviously a high probability inversion fair value gap, and it hits it here, respects consequent encroachment, breaks down, and then we have another return in here. Here's an optimal trend entry as well. And everything is your mindset is, okay, I'm looking for lower, I'm looking for lower, I'm looking for lower, and it breaks lower. And then you highlight every single time it creates an inefficiency where it's a big candle that doesn't have any overlapping with the candle prior to it forming or the candle after it. So it creates that inefficiency, that imbalance. And then when you have these long protracted consolidations like that, it's really better for you to sit still. Let them do whatever they're going to do. Why? What do we have there? We have relative equal highs and we have relative equal lows. You're going to be playing the breakout game. And I'm not a breakout artist. I'm not trying to guess. I want to see what the market's going to do. So by this run up, it can trade into any one of these fair value gaps in here. It does. And does it fall out of bed? Yep. So we want to see this fair value gap as an inversion fair value gap. Well, that means it ran above it. It's got to go below it and then do this right there, that function of redelivering to it. Then a deeper protraction lower to upset any liquidity that would be resting below here, as much as and to the degree of reaching down into that low over there, because that's the low in London. You see that? So what I'm only interested in seeing anything before 7 o'clock if the range of the morning session trades to the London session low or the London session high. Okay, that's it. So all your charts are going to have about 6 o'clock or so, just to get a little taste of what London was doing. And then everything else in your charts need to be very, very simple, but I want 9 o'clock delineated, 8 o'clock delineated, and 7 o'clock delineated. And any formation of relative equal highs or lows, I want you to annotate them. All right? And that's the relative equal lows and the relative equal highs. You wait for them to take one side out. What does it do? It runs higher. So what's it going to attack now? That one. And it runs down below it. Okay? So as it is right now, if there was any trade taken or no trade taken at all, you would do nothing because it's already done a whole lot of movement and it's back in an area where I wouldn't want to see it as a trade back in this civvy again, because we've already done once, twice overlapped it, respected it, and now we're back inside of it again. That is low probability because it's against the rules of me wanting to use it. It's been overlapped and worked multiple times and it's done enough. So you have to have an expectation on price at a time of day. In this case, you have 3 specific times of the day. And the first 30 minutes after 7 o'clock, after 8 o'clock, and after 9 o'clock, if there is relative equal highs or relative equal lows below the marketplace, then you want to see a move the first 30 minutes go in the opposite direction up. If there's relative equal highs that form after 7 o'clock, after 8 o'clock, and after 9 o'clock, that first 30 minutes, you want to see the market drop. You want to see a measure of manipulation. It doesn't have to only be in that first 30 minutes. But in my mind, I'm thinking, I want to see that. And if I got that, and it was given to me in delivery price, then my interest in this move is even more peaked. I'm really interested in it. If it doesn't do it, I'll wait for more information because it might have a deeper retracement than I would have expected initially. And then I'll wait for a breakdown. And then having all these inefficiencies extended over, the market will refer back to them. And then all I have to do is wait for a bus to get there and then ride that thing down to Southern Town.